following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Good morning, everybody. Let's talk futures. We are back live with Blu Putnam. Blu, good morning.
Oh, good morning, Jim. Very good morning, actually.
Well, that's good to hear. That's good to hear. How's everything going up in the northern eastern seacoast?
Well, it's a cloudy day, but further north it's raining, so we're in good shape.
Well, that's good. That's good to know. Now you're nowhere. Are you anywhere near Baltimore by any chance? By the bridge collapse?
I'm about an hour and a half away. Yeah, I mean it's a pretty important transit, that bridge collapse, but they are really working hard to clear it. They've already opened some small channels for tugboats and barges. It's an amazing job. They're already proven they can do it in record time.
So it's a two-step process, right? Step one is clearing the channel for traffic for the container ships.
Right.
And then step two would be to rebuild the bridge, which my guess would take a lot longer.
Yeah, rebuilding is a matter of years. Clearing is weeks and months. I mean, getting the structure, getting the main shipping channel open is the hardest. They're getting some smaller channels that aren't so deep open, but the shipping channel, and then they got to get that ship moved. That's not so easy too. It's all kind of tangled up in it.
Yeah, right. And there's a lot of containers. You can't get a crane, probably. Maybe you could. I don't know if you can get a crane big enough to start peeling those boxes off one at a time.
Oh, you definitely can do that, but they got to figure it out. But they got a crane there that'll lift 1,000 tons. But today it's lifting a 350-ton piece of the bridge because they cut them in parts and lift them up. But that's the biggest crane on the East Coast. They brought it in at 100 miles an hour.
Yeah. So do you feel like, maybe the supply chain's not going to be really long-term impacted anymore?
Probably not. I mean, Baltimore was a very big port for cars, particularly Volkswagen and a few others. Some of the cars are offloaded outside of what the bridge did before you go into the main harbor. So it's not 100% affected. And then on the export side, it's coal. And that will maybe have a small impact on the coal price in India. I mean, that's what but in terms of container ships and things like that, there's so much capacity in excess capacity in ships, and there are many other ports up and down the East Coast that can handle the containers. So it's really a cars and a coal story. Or the only big ones.
Yeah, so I'm going to brag a little bit about the Port of Carolina down here in Charleston being the deepest port on the East Coast.
And one of the earliest from the 1600s.
Yeah. And we've seen a little civil combat there too, but that's a whole nother conversation. And it's funny, we're not even talking about what we were supposed to talk about yet. So let's kind of pivot in that direction right now. I get a lot of questions about the equity, rather spectacular rally we've seen in equities in the last few months. And do equities like high rates? Do they like low rates? Do they like cuts? Do they like hikes? What's going on here?
Well, there is a lot going on. So let's see if we can unpack a few things. Equities like low rates better than high rates, but not all equity indexes are created the same. So if you're just isolating on rates, NASDAQ is the most sensitive because the earnings are further out into the future. And what do interest rates do? They help you value things that are going to happen way into the future. So lower rates give you a higher valuation, high rates a lower valuation. So when they finally raised rates in 2022, NASDAQ took it harder. S&P was in the middle, and Dow Jones also got hit, but those are more mature dividend, slower growing companies, so they weren't as bad off. So that's kind of the rate story. But there's, many other stories going on.
Yeah, but okay, so let's think about that for a second. So the Dow is an example. I would imagine that Dow companies have a lot of cash on hand for CapEx, for reduce their borrowing costs anyway. So wouldn't they be better positioned than, let's say, your average NASDAQ stock?
Well, as an equity market, when you have a lot of cash on hand, it means you don't know what to do with it. And if you really knew what to do with it, you'd put it into your company. So what you do with it instead is you buy your stock back and other things. But a lot of tech companies have cash on hand. These aren't the tech stars of 1999 that didn't have earnings. These are mature companies that are printing money right and left. So there's cash across the board, and I don't think that's the issue. Because if you had a ton of cash and you wanted to grow your company, you could. And the fact they're holding the cash means they're not sure what they want to do with it.
That makes sense. That makes sense. I know it's easier to plan for CapEx years ahead of time if you have big projects, right? And now it seems like, as you pointed out on let's take a peek at the chart on the right real quick. AI seems to be the big thing.
Well, AI came in 2023, and it really brought NASDAQ back up to where the Dow and the S&P, because the NASDAQ got hit harder by the rising interest rates of 2022, and AI allowed it to catch up at a very fast pace, and it completely caught up. 2024 is really very different because the Magnificent Seven aren't so magnificent anymore, and they're not seven. You have the magnificent NVIDIA, okay, and Microsoft and Meta are doing okay, but Tesla is declining and having a very bad day-to-day after telling us deliveries weren't working so well. Apple is certainly struggling with people not, upgrading their phones as often as they used to, and they deal with what the politics of U.S. and China. So Apple and Tesla have been underperformers in 2024. So some people say it's the fabulous four now. I'm not so sure. I just think we're breaking up the magnificent. The band is broken up. It's what's happened.
Well, but at a certain point, so AI in my mind is synonymous with machine learning, whatever that means. And doesn't that kind of spread from the Magnificent Seven or Four to everybody else who adopts those types of techniques?
Well, it does spread. So let's go back to your definition. AI and machine learning are very similar things. AI, as it came on the scene, was really a lot about text. Machine was a lot about data, but it's all pattern recognition. And we've had these kind of pattern recognition tools forever. It's just they've gotten better and better and better. And so we've just had another upgrade with our pattern recognition toolkit. The interesting thing about where does AI spread? Well, it spreads to data centers because AI eats data big time. So you've got to have bigger data centers. And what do bigger data centers mean? You've got to have more GPUs. You've got to have more of the computers in there, more servers. That's NVIDIA. And wait a minute, you've got to have more servicing of, you got to actually cool these data centers. So some of the companies that provide cooling have seen their stock prices rise. So the biggest impact to date, aside from providing the chips, has been related to helping the revolution, if you will, in massive data centers and all the things that it takes to build them. And of course, they eat electricity like crazy. So that's going to be another issue.
So Interesting you say that. There's that big facility I think they're building in Arizona, which ran into some roadblocks, and now it's pushed back a little bit further, right? It takes a long time to build these things, right?
That's right.
But once
But
it's online, that'll be another stake in the ground.
yes, and companies are going to have to decide, do they want to own their data centers? Do they want to rent them? Obviously, the big players, the Googles and so forth, are going to want to own them, but other players may choose differently. It's huge business.
Okay, so
But
that's interesting.
interesting that we went from AI into actually the hardware and the compute systems. The companies that are trying to use AI to actually reduce costs are the ones that are still, they're probably going to figure out how to do it, but it's not as easy as they thought.
So do you mean like manufacturing companies and
Manufacturing companies, but also routine reports. You might have a credit agency and they have to write all these reports on companies. AI can help on that. But how much does it really help? How fast can it really? It can mainly do routine tasks. Let's go back to the pattern recognition. Most of the AI tools we're seeing requires tons and tons of data to learn. And then once it's learned, it doesn't learn anymore. Okay. So it's great for something like radiology. You have lung scans, you have MRIs, you've got tons of data. And so you can feed all this data in and you can build a machine learning or AI tool that can read a tuberculosis scan better than a doctor and just kick out out of a couple of 10,000, they can pick out the 100 that need a doctor to really study. That's hugely efficient. But the key was there was a lot of data already existing. What AI has trouble doing, I'll stay in radiology for a second.
okay?
It doesn't make good diagnosis. It can't figure out the treatment. It can figure out the problem, but the treatment's harder because a lot of the treatments are new. And guess what? A new treatment doesn't have a database. And so AI is quite hampered in those kind of things. But so we're going to be able to use AI, but the dynamic, making it adjust its pattern recognition as it goes along, learning something new. I mean, that's why if you're going to use AI for trading, you better be really careful. If you trained your model on zero rates, it's just going to lose a ton of money now.
So it's less predictive, right? So if you had, let's say, we have the go back to the doctor, right? The doctor has treatment A, and the other doctor has treatment B, and you're not going to get consensus and predict, is this going to be the right treatment for you?
Because you don't have enough history of the new treatments. Without a large data history, AI doesn't do much for you. So there are many applications for AI, but only if you have a large data history. And for some things, you just don't, like new treatments, or say financial markets that central banks have just changed the game.
Yeah. Okay, that makes sense. That makes sense. From a layman's point of view, AI is simply ChatGPT or Grok on Twitter, right? And ChatGPT scrapes the internet, comes up with an answer. Grok scrapes Twitter, comes up with the answer, and the data is not always. I always have to fact check.
Well, you do, because AI has an interesting ability to hallucinate. And if you're in the fact business like you and I are, that's a flaw. So we always have to check. But if you're in the creative business, like you're an artist or a photographer and you're doing all kind of things, maybe making a movie with AI, hallucination is taking you off the charts, doing something different. Maybe it helps your curiosity and your creativity. And there are ways, by the way, to control hallucinations, but mostly it's curating your data. So you don't just take a big pile of data and run it through AI. You clean the data so you're very comfortable with its accuracy, and then you use AI on it. Turns out cleaning the data takes way longer than using the AI.
Yeah. Well, it's interesting. We'll see where it goes. I mean, not going to go away, right? We're going to continue to improve our data analysis and come up with solutions, and maybe a little bit of predictiveness will pop out of that. But let's talk about some facts, though, and let's go back to this whole. Forget about the rise of AI for a second. Let's talk about the actual Fed funds rate and how they're related to the NASDAQ as an example.
Yeah, I like to use NASDAQ because it is the longest duration, most interest rate sensitive equity index. What kind of surprised me was bond yields, like the 10-year bond treasury yield, started rising in 2020 late 2020, really 2021, as we came out of the pandemic, and NASDAQ didn't care. It was still responding to zero rates, quantitative easing, and those things. NASDAQ really didn't care about rates till the Fed convinced the market it was going to start raising rates. And then, and then NASDAQ took a pretty big hit. However, we're in a different place now. We're at 5 to 5.5, 5.25 to 5.5 Fed funds. The Fed's, kind of toying with us about when they might make the first cut and how many cuts. But I got to tell you, 2 or 3 cuts isn't going to make any difference to consumer behavior. It isn't going to make any difference to investment behavior. The economy doesn't care about small cuts. You got to do something really big. If you take it from 5 to 2, hey, yeah, you're going to get a reaction with the economy. So I think we've shifted gears now to a much more earnings-driven market. And as long as we keep creating jobs, we're going to keep spending money and the earnings are going to go up. So I think we've left the rate sensitivity, or are leaving it, I should say, in terms of how equities respond.
Okay, so we shouldn't really have a concern about corporate debt, right? Right now, I think corporate AAA effective yield is about 4.78 compared to maybe 4.45 last year. It doesn't look like it's moved a lot. And is that a factor in some of these companies?
In the publicly traded companies, it's not too much of a factor. The yields are tight. Credit quality is good. It's in the private credit area that you have to be very careful about. These are companies that are not public. They are partly, at least, not serviced by banks. And at least $1 trillion has gone into private credit in the last year or two. I mean, it's the hot area. It's the hot area in part because private equity has slowed down. Private equity is when you basically buy the stock in these non-public companies through a private equity fund. Private credit is when you lend these same companies money. And by the way, since we're trading futures and options here, buying private credit is like buying a call option on the assets of the company. If the assets of the company grow a big time, you're going to make a ton of money eventually, whether it stays private or goes public. Private credit is writing a put option on the assets of the company. If the company grows and the assets grow, they're going to pay the loan back and refinance at a lower rate. And you're going to get screwed. And if the company goes bankrupt, they're going to put the company to the private credit lender at exactly the wrong time. So the risks of these two kind of non-public investments are very, very different and are much more related to options than people realize. The people that are buying them, I think, actually realize. But they do tend to follow public markets they've outperformed public markets, by the way, in the zero rate days. I'm not so sure they can do that in the 5% days.
But right now, though, with equity prices high, it doesn't make sense for the private equity guy to say, hey, let's go public.
Well, if you read it, you pulled it off in pretty good style. But there's still a lot of the private equity companies that can go public are the ones that have positive free cash flow. If you're still not profitable and burning through cash, that window for IPOs hasn't opened all that much, although it did for Reddit. But Reddit had the AI story.
But what about Truth Social?
Yeah, what about it?
Well, the revenue is not there. The free cash flow is definitely not there.
It's definitely has a cash flow issue, and that's the reality of the company, but you against the promises that are made.
Yeah. Yeah, you're
Well,
betting on the future there of that.
you are, and of course that means you're buying a call option.
Yeah.
You pay whatever you pay up. That's how much you can lose, and
Yeah.
can you make a lot of money? Only if the future works out.
Yeah. Well, going back to the chart here, you have a comparison between the NASDAQ 100 and the 10-year yield, not 10-year price, 10-year yield. And it looks like well, right now, it looks like it's maybe back to being correlated positively.
It kind of looks like that, but there was a little correlation when the Fed was raising rates because that pushed the 10-year yields higher and the equities were going down. And there was another piece of correlation where the yields went up and equities went up. And that was after the Fed stopped.
Mm-hmm.
So that was the AI revolution. I don't think, let me put it this way. I think equity indexes, NASDAQ included, have come to terms with a 4.25, 4.5, 10-year. And so it's got to move a lot to influence equities now.
That it makes sense.
That's my story that we've moved into an earnings driven market and we're not a rates driven market right now anymore.
Got it. All right, let's take a peek. Okay. Yeah, and earnings kind of got in the last 2 years, earnings have kind of been not ignored, but not the story. And now you're saying this is now the story.
I'm saying that, yes, the narrative is switching to earnings and it's going to separate different companies. If you were in the Magnificent Seven, we had high earnings out expectations for everybody. Now we're getting very specific. Maybe not for Apple and Tesla, maybe yes for NVIDIA. So earnings is going to separate the stocks and separate the indexes. In the earnings, again, as long as we're not in a recession, if the jobs are growing, then that's going to be the narrative. If we go into a recession, then the narrative will switch on a dime, but that's not what's happening.
So let's talk about employment really quickly. You open the door a little bit for me there. At what point, right? JOLTS came out today and you told me that, it was revised. The last report was revised. Today's wasn't so bad. It seems like in general, the employment situation is still pretty positive.
Oh, it is very positive. And many of us, I never had a recession in my forecast, but it's still surprising me how positive it is. We're just creating jobs every month. We're bringing people into the labor force that weren't there or that left during the pandemic. And of course, when people have jobs, they spend money. So the economy keeps on chugging along.
So I guess my question then would be, what would have to break in the economy for the Fed to, step in and do something?
Something would have to happen that caused jobs to be lost in a lot of industries all at the same time. Okay. We did that with the financial crisis of 2008. We cut off lending to everybody, and they had to cut back. We did it with the pandemic because we shut down, the hospitality sector, at least in part. But you have to have something that dominoes through so that we're losing jobs all at the same time in a lot of different places. We are losing some jobs now. We're losing a few in the finance sector. Citibank's laying off some more people. We're losing some in the technology sector. Some of these companies expanded a little too fast when they benefited from the pandemic and they got really big, and they're still bigger than they were in 2019 in terms of jobs, but they're, resizing a little bit. But there's nothing out there that says our jobs are going to be lost in a lot of different sectors all at once. And 5%, 5.5% interest rates are not going to cause that.
Okay, so then the dual mandate's only a single mandate for now anyway.
Well, it's an inflation mandate right now because you can check the box. I got two things to do, and I've done one. The employment one is checked.
Right.
But it's interesting as to which piece of data might be the most important. Some people are saying it's inflation, and they're the ones that are focused on when's that next quarter point coming cut on rates. And there are other people like me that, no, I'm watching the job market more than inflation because I want to know if there's any softness or uptick in consumption that could lead to profit growth or the meter revise. So I'm telling those of us telling an earnings story are still following the jobs market. Those of us telling the inflation story are just myopic about the Fed. And I got to tell you, a quarter, half a point, it's not going to make much difference for the economy.
Right. And in three rate cuts is only 75 basis points. It sounds like it's more, but it's not.
Yeah, it's nothing. I mean, it's not nothing, but it's in terms of your business and consumption plans, it's not going, it's in the era term. So it's not going to have much of an impact. So when you hear people say, wow, if they cut rates, it could overstimulate the economy. 75 basis points is not going to overstimulate the economy. And by the way, 500 basis points up didn't hurt the economy. These people that think you can just dial the rates and change the economy are just all wrong. And that includes, unfortunately, a lot of what we get from the Fed. They're not as powerful. Rates are not as related to the economy as you might think.
Well,
unless, of course, they move big. If we had 10% rates, I'd have to change this story. But, a couple of points above inflation, no big deal.
Okay. Well, so I was looking at the nowcasts. Everyone has a nowcast, right? Q1 2024, the New York Fed nowcast was, as of March 29th, was estimating at 1.87% for GDP, but they had a one standard deviation calculation, which brought us down to about 0.7%. So within one standard deviation, you're 0.7, getting closer to that zero level.
Yeah, but that's not what I think the economy is doing better than that. 200,000 jobs a month, 4%, less than 4% unemployment. The new unemployment insurance claims very low. Job openings doing fine. No, I don't know what's going on with that particular nowcast, but I'm not buying it.
All right. Well, they all have different ones. Atlanta Fed has theirs. I think Cleveland has theirs. I think is focused not on GDP but on inflation, or core PCE, that kind of thing. So they're all trying to get into that. Maybe they're using their AI to come up with these numbers.
It would be, I don't think they are, but they tend to take the numbers that they can already observe and then say how to, so that's particularly like the Atlanta Fed. So what data have we gotten so far about the first quarter? And that goes into their real GDP, and we get a new piece of data and they update it. The Federal Reserves don't look ahead that's just not what they do. That would put them in the forecasting business, and they'd rather be data dependent. We could build one for Ninja that would be data, forecasting, and then we could be wrong too.
Right. Wow. Yeah. So Friday will tell, right? Friday we have, I think it's, we used to call it when we were in the pit, unenjoyment Friday instead of employment. Unemployment was the report. Then somebody changed it to be the employment situation because the word unemployment was too negative.
That's right.
And that's Friday, I guess.
That is Friday. We've been on a little bit of an uptick in jobs, so downtick. As you can see, these things zigzag a lot, and they can zag twice before they zig. But I would say the odds are on a little smaller number than previous months, just because it's a mean reverting number.
So last question, we're running up against time, but last question on these numbers. Do you feel these are solid numbers, or they're a little bit sloppy in their genesis?
They are a little bit sloppy, but you would not find the conclusion to be different if they were a lot more accurate.
Okay.
So the sloppiness is there, but it's not going to cause you to make the wrong conclusion. And by the way, you have 4 or 5 of these things. You got the payroll survey, you got the household survey, you got the weekly unemployment claims. You put them all together to form your view, but right now they're all telling you the same thing. So, I mean, I can go into the deficiencies within each of them, but it won't help you forecast.
Yeah, no, I know, and I don't want to use the word rigged at all, because they're not. These are folks that are honest, that do a good job collecting data the best way they can. I was a Fed. I could attest to them.
Yeah, I agree with that. I mean, I'm complaining a lot about the owner equivalent rent, but they put that in the 80s.
Yeah.
It wasn't something new for today. It just is the fallacy and the problems are just now showing up.
Absolutely. Well, we're up against time, Blue. Again, as usual, I appreciate your insights and spending time with us here. Looking forward to having you back on next week.
Sounds good. Let's talk about commodities next week. There's a rally going on.
All right, let's do it. That sounds good.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.